This material that we're going to be doing next can get really tricky, very complicated. A lot of the details are convoluted and it's all interconnected in this strange way that makes it confusing for students at times. So to try to make it as easy as possible, what we're going to do is we're going to run through this simply, and then we're going to add on the intricate details, which will allow us to do analysis and to think about what the Fed is actually doing right now in the United States. So specifically, what we're going to be talking about now is the 5 ways the Fed adjusts the money supply. And this is something that I go over at the simple level, at about the level we're going to be doing right now when I teach principles of macroeconomics. But I know a lot of other professors really don't talk about this hardly at all. So I need to make sure that you've got the foundations to build upon. This is really core ideas for this class. This is some of the most primary concepts for money and banking, is the policies that the Fed has. This class is money and banking, and we're learning about how the Fed changes the money supply using the banking system. Very connected to our ideas in this class. So we're going to run through these as simply as we can. Try to start with the easier ones, and then we'll get more complex. So, number 1, we'll start with a nice simple one. Open market operations. Open market operations is when the Fed buys stuff with newly printed money. Okay, so this is the very straightforward approach that the Fed can make. They simply create money and then they buy stuff with it. Okay, sometimes students in my principles course, they get very confused about what the Fed can do, and they'll just say, well, the Fed can, I'll say, what are the 5 ways the Fed can increase the money supply? And they'll answer with, well, the Fed can print money. Printing money doesn't create new money in society. You've got to figure out how you're going to get it into society. And oddly, the Fed doesn't actually print the money. Instead, it chooses how much money will be printed. The Federal Treasury, which is part of the federal government, decides how to print money. It's the Federal Reserve, the central bank of the United States, which isn't part of the government, that decides how much of that money will be distributed into the economy. And if you think about it, printing money is easy, right? We could find any company to print money for us. Deciding how to get it into the economy and how much of it should exist, that's the hard part. And that's what the Fed does here. All right, they print money and then use it to buy stuff. Typically what they buy is government bonds. And when I say that everything is interconnected and complicated, this is what I mean. When we think about the debt that the U.S. government has, we also have to think about the Fed. To think about that, we've got to think about how bonds operate. And what that means is basically there's a lot going on. And when I'm thinking about teaching this material, I've got to jump in somewhere, okay? So we could start by learning about bonds, but we wouldn't really know why we'd care about bonds. We could start by talking about the federal government, but then it would be unclear how the Federal Reserve is involved. I got to start somewhere, okay? So I'm starting here with the Fed. We'll talk more about government bonds in the future and how they work, okay? So the Fed will go in and buy government bonds if it wants to increase the money supply. So that's one option, right? If it wants to increase the money supply, it can go in and buy bonds. Typically, these bonds are pre-existing bonds, which means that the Fed is not going to the government to buy the bonds, but rather they're buying bonds off of people who already own it, okay? This generally happens through the banking system. Banks have bonds, banks have customers that have bonds, and so the Fed will go to banks to try to buy these bonds up. If they're not able to buy enough, they'll have to offer higher prices, all right? So they can increase the money supply by buying bonds. They also can buy other stuff, but bonds is what they typically deal with, those government bonds. And if they want to decrease the money supply, well, then they can sell bonds and then destroy the money. So open market operations gives the Federal Reserve the power to both increase and decrease the money supply. Now, why would you want to increase the money supply? The simple reason is if the economy is struggling, right? If the economy is weak, putting money into the economy can help stimulate things. So that might be a good reason to increase the money supply. Maybe inflation rates are too low, okay? Maybe you want inflation to go up. Increasing the money supply will work. All right, so you can imagine why you want to increase the money supply. But there's also reasons why you might want to decrease the money supply. Maybe the economy is too strong. Maybe the economy is in that classical inflationary gap that we talked about. So you want to slow it down a little bit. Well, you could do that by decreasing the money supply. Maybe there's too much inflation, okay? So for the Fed, it's not like they're just constantly increasing the money supply over time. Rather, they're aiming for a target. So they might be aiming to increase the money supply by 1% over the next week. And to do that, they might have to do some buying and a little bit of selling to realize those goals. So the first policy that they could enact is open market operations, buying and selling stuff. Next, we're going to talk about those rates that we were discussing. Remember the three different rates that we have to keep clear in our heads? So the second one that we'll discuss, this is another pretty easy one, is altering the required reserve rate. This has to do with basically affecting that money multiplier that hopefully you're very familiar with at this point. Okay, as we know, the required reserve rate determines what the money multiplier will be. We saw the formula for that, right? The money multiplier is 1 over R. So that means that if R is 10%, the money multiplier is 10. Every dollar that is created in society can generate 10 total dollars in money. So imagine the Fed putting $1 into the economy. That $1 could generate an additional $9 for a total of 10 in terms of M1 or M2. Okay? So $1 of currency could create 9 additional dollars in M1, for example. If we drop the required reserve rate down to 5%, then the money multiplier could be 20, right? And to be clear here, this is kind of confusing, talking about the money multiplier here, right? So if R is 5%, 1 divided by 5% is 20. So anytime the required reserve rate is dropped, the money multiplier comes up. This is an incredibly easy tool that the Fed has at their disposal because they don't really have to do much, right? Like right now, they could just announce that they're going to change the required reserve rate and you could get some pretty big policy effects. We'll talk more about the limitations of this approach in the future, but for now, we're keeping it simple, okay? So here's what you need to know. To increase the money supply, you need to reduce the required reserve rate. And to decrease the money supply, you go the other way. Both of those policies will potentially work. We'll talk about whether they're viable or not and which ones might be the easiest for the Fed to use. As you'll see as we start to roll through these and get more complex, sometimes these policies are good at going only in one direction, but not the other direction, all right? So we'll need to backtrack and think about this more in the future. So we've got open market operations. We've got adjusting the required reserve rate. And next, we're going to start thinking about the discount rate and the federal funds rate, okay? Turns out the federal funds rate and discount rate are connected, and it's important to understand the connection between the two. So the third way that the Fed can adjust the money supply is by adjusting the discount rate. I got to be really careful with the discount rate because it doesn't always matter. In other words, when the Fed raises or drops the discount rate, only in some circumstances will that really have any meaningful impact on the money supply in the economy, okay? So let me give you an example. let's say that this is Bank of America, just to choose a big bank. And right now they have deposits of $200 million and reserves of $18 million. And we're assuming that required reserve rate is 10%. So right now the Bank of America is breaking that rule. They're breaking the 10% required reserve rate rule, right? So they're going to have to figure out a way to get some money. They don't get punished right away when they make this kind of mistake. There is a little bit of leeway in terms of adjusting their financial situation. But they're going to need to borrow, okay? So they're going to look at the two options that they have. They can borrow from the Fed. It's called a discount rate. Or they can borrow from other banks. That's called the federal funds rate. All right? So in this circumstance here, they're going to look and see what their options are. And maybe this is what they see. They might see that the discount rate is 8% and the federal funds rate is 5%. Now, given that information there, who are they going to borrow from? They're going to choose whatever rate is lower. Just like if you're borrowing money, you would choose the lowest interest rate. Banks are the same way. So they're going to borrow using the federal funds rate, which means they'll borrow from a bank. So in this scenario, they borrow from a bank, and that would have no impact on the money supply. So this would have no effect on the money supply. It wouldn't do anything because they're not getting new money into the economy. It's just money moving from one bank to another. So this wouldn't have any real impact on the money supply. We might double back on this in the future and think about some not so obvious reasons why this could affect the money supply. But for our purposes now, in this circumstance, no money is created. Okay? So the Fed might decide to drop this rate down. And they might decide to drop it down to 4%. Okay? This is going to change everything. When they drop that discount rate down to 4%, now banks borrow from the Fed. And when they borrow from the Fed, this now creates new money. When banks borrow from the Fed, they're borrowing money that otherwise wouldn't be in the economy. So it's bringing fresh money into the economy. So this would increase the money supply. So if the Fed wants to increase the money supply, it can do so by dropping the discount rate. However, we need to be careful. When I ask this material in my principles course, I very frequently get students who make this mistake. I ask them to explain how the Fed can increase the money supply, and somebody will put an answer like, the Fed can drop the discount rate. The problem is, that answer in and of itself is a very weak answer, and in fact, it's a bad answer. Okay, I give no credit when students give that answer there, because this isn't necessarily true. Going back to our example we just had, we've got a discount rate of 8% and a federal funds rate of 5%. If the Fed goes in and drops the discount rate to 6%, how will that impact the money supply? All right, think about being a bank in this situation. If you need to borrow money, initially what you would do is borrow from another bank at 5%. Now that the Fed has dropped the discount rate to 6%, you would still borrow at the federal funds rate. You see, the discount rate only matters if it's below the federal funds rate. Okay? So if we're going to be exact and we're going to be accurate, the simple answer to how does the Fed adjust the discount rate if it wants to increase the money supply is it needs to drop the discount rate below the federal funds rate. All right? And the reason that works is when the discount rate is below the federal funds rate, banks will now borrow new money from the Fed instead of borrowing pre-existing money from banks. We're going to discuss this in more detail as we continue on with this content, but one interesting thing about this is it can only be used to increase the money supply. All right, so what we will learn is it can't really be used to decrease the money supply. All right, I'll leave that for now. We'll come back to it later. All right, so we've talked about open market operations, adjusting the required reserve rate, adjusting the discount rate, and number 4 is going to be the most important policy. This is the key policy for the Federal Reserve. So I'm going to put a little asterisk next to it just so we remember. Okay? Number 4 is adjusting the federal funds rate. And before we can even get into what the Fed does from a policy standpoint, we need to understand why the federal funds rate matters at all. Okay, we need to understand how it factors into this decision. It's very different from the other types of policies. The other 3 policies we've talked about are very straightforward and very strong, clear-cut policies, like open market purchases. Fed creates money, buys stuff, clear-cut. Lowering the required reserve rate. It just literally changes the rules that banks face. Adjusting the discount rate below the federal funds rate. It changes who the banks are going to borrow from. Those are pretty easy. This one has to do with the incentives that the banks face. Okay, so let me give you another example here. Let's think about BB&T. Imagine they're in this scenario. They've got $400 million in deposits, and they have reserves of $70 million. Okay, and we'll stick with that required reserve rate being 10%. So think about that situation that BB&T is in, okay? $400 million in deposits, $70 million in reserves, and the required reserve rate is 10%, okay? In this situation here, BB&T has to hold at least $40 million, right? Given that 10% required reserve rate, they have to hold at least 10% of deposits, so they have minimum reserves of $40 million, okay? But they're actually choosing to hold $70 million. So they have something called excess reserves. This is a key term. I'm not going to write the definition, but I am going to explain it, all right? I think it's a pretty obvious definition. It's extra money that banks hold by their own volition. It's extra money that banks choose to hold even though they're not required to hold it, okay? So in this case, they've got $70 million in reserves, $40 million as a minimum required reserve, so they have $30 million in excess reserves. Excess reserves are very important because excess reserves represent where the bank has a choice, okay? With $30 million in excess reserves, they could loan some of that money out or they could hold that money. If they decide to loan more of that money out, you'll get more money in society, right? If they loan out the $30 million, you get $30 million right away of new money into the economy via M1 and M2, okay? Furthermore, when the $30 million goes into the economy, it itself could get multiplied many times over. So the choice of what to do with excess reserves is a really important one in our economy, okay? So thinking about BB&T, they've got their $30 million in excess reserves. So they're going to try to decide whether or not they want to loan that money out. Now think about what they would consider when they're trying to loan money out, okay? When they're thinking about whether or not to loan out that $30 million, they're going to be thinking about who they would loan it to. Are buyers going to pay them back? Borrowers going to pay them back? Is it risky or not? What sort of interest rate are they going to earn? All these things are going to matter. But it turns out that a lot of times they're thinking ahead of the current loan they could make and instead considering what would happen if they run out of money, okay? What I mean by that is when they're thinking about whether or not to make a loan, what they're really thinking about most clearly is what will happen in the future if they need to borrow some money, Okay? If they loan the $30 million out, that increases the odds that they're going to need to borrow in the future. So they're going to want to know if they have to borrow, what sort of rate do they face. So they're going to look back to the discount rate and the federal funds rate when making this decision. So let's imagine scenario one. They look at the discount rate and they look at the federal funds rate and they see these extremely high rates. Okay? Remember, they're trying to decide, should they loan their excess reserves? And they're thinking if they loan the money, they are far more likely to have to borrow money in the future, right? Because keep in mind with banks, at any point, customers can come in and start withdrawing money. So there's always a potential for banks to go below the 10% required reserve rate. So think about it. If you're a bank, if you know these rates are so high, what would you do with your excess reserves? You'd probably hold on to them, all right? The incentive here is to hold excess reserves. And there's two reasons why they would want to hold excess reserves. I think one is more obvious. One, so they don't have to borrow. If they have to borrow money, they will be forced to pay a 50% federal funds rate, right? They're going to choose which of these is lower. So 50% right now is going to be the preference there. So if they have to borrow, they're going to have to borrow at a 50% rate. Imagine if I told you right now, if you need to borrow money in the future, you're going to have to borrow at a 50% rate. You would probably feel more compelled to save money knowing that you don't want to borrow. It's no different for banks. When they know rates are high in the federal funds market, they're going to hold extra money so that they don't have to borrow. That's not the only reason why they'd want to borrow, why they'd want to hold extra funds. There's a second reason. The second reason is that they would like to make loans in the federal funds market. In other words, banks would like to be the entities that are loaning money in this market, not entities borrowing money in this market. So they'll hold extra money in case they're able to find a bank that needs to borrow. Okay? I said this can get really complicated. It can. Some of you may already be starting to think about things in regards to the federal funds rate that are beyond our level of expertise at this point. Okay? So I'm going to stop right there and just say banks hold excess reserves when the federal funds rate is really high. On the contrary, when the federal funds rate is really low, they'll have the opposite effect. Think about a scenario like this. This is close to where we are right now in the U.S. You know, you've got a very low discount rate and a very low federal funds rate. Think about this scenario here if you're a bank. If you need to borrow, that's no problem, right? If I told you right now that you can borrow at 0.25% interest, you'd be way more likely to use the money that you currently have because you know it's cheap to get new money if you need to. So in this scenario, banks will tend to loan the maximum. Okay? In that scenario there, banks will tend to loan the maximum because they know that there's no real punishment if they need to borrow money. Okay? So here's what we basically know so far. Here's what we basically know so far. When the federal funds rate is low, banks are more aggressive with their loans. I wish I knew how to spell aggressive. That doesn't look right. Whatever. All right, when the federal funds rate is low, banks are more aggressive with their loans. So this doesn't change how much currency is in society or anything. But what it does do is it makes the money multiplier more viable. It makes the money multiplier work closer to its full potential, okay? So if the required reserve rate is 10%, like it normally is, the maximum money multiplier is 10. We haven't spent too much time talking about this yet, but the money multiplier is the best case scenario or the greatest outcome you could possibly have. For the money multiplier to be fully realized, banks have to loan out the maximum. They have to hold $0 in excess reserves. Okay? So when the federal funds rate is low, banks will loan out closer to their maximums, which means the money multiplier will get closer to being fully realized. Okay? So a lower federal funds rate stimulates the bank's loaning process, which creates more money in society. All right, all of that just discussed how federal funds rate matters. We didn't at all think about how the Fed actually adjusts the federal funds rate. So that's what we need to do now. The thing about the federal funds rate is the Fed does not control it directly. It's kind of like saying, who decides how much a cheeseburger costs? Well, the businesses and the customers decide, right? It's supply and demand. The federal funds rate operates based on supply and demand, okay? So adjusting the federal funds rate, we got to first recognize that the federal funds rate is determined by banks, not the Fed. So it's not like the Fed can just go in and change the federal funds rate. It doesn't work that way. It's just not how we have it set up, okay? Banks can charge each other whatever they want when they're making a loan, right? That makes sense, right? If one bank wants to loan money to another bank, they can charge each other what they want for those loans. However, the federal funds rate is highly dependent on what the Federal Reserve is doing. The Federal Reserve knows how to steer the federal funds rate in certain directions, okay? There is a term for this. You'll hear it referred to as targeting. Federal funds rate targeting. All right, and this is basically just intentional methods the Fed uses to influence the federal funds rate. The Fed cannot change the federal funds rate, but it is very good at manipulating and targeting a certain federal funds rate. So the Fed might come out and say, we're targeting a 1% federal funds rate. And then a couple days later, you go check your computer and see what the actual rate is, and you find out that it's like 0.98%. They're pretty good at getting close to their target rate level. So how do they do that? Well, it turns out that we already have the tools to think about how the federal funds rate is determined. The Fed manipulates the federal funds rate through its other policy tools. Through the ones that we've already talked about, 1, 2, and 3. We're going to get to a fifth one, all right? It's kind of different, so I'm leaving it off for now. But those first three things we talked about, open market operations, adjusting the required reserve rate, changing the discount rate, those things are used to change the federal funds rate, okay? This sounds kind of weird. It's a little bit backwards in terms of how you might expect the Fed to operate, but it turns out this is how they operate. They think we need to change the money supply. All right, that's their first step in thinking, is how do we need to change the money supply? All right? Where their head goes next is not how do we do that, it's how do we do it using the federal funds rate. All right? So when they're thinking about choices they're going to make, they always start here. You see, they always start by thinking about the federal funds rate. But here's the problem. To adjust the federal funds rate, they need to first change one of their other things, do one of their other policies, okay? So what they'll do then is use one of those other policies to adjust the federal funds rate. So they'll think, we need to increase the money supply. All right, we need to increase the money supply to stimulate the economy. Okay, well, that means we need to lower the federal funds rate so that banks will be more aggressive with their loans. All right, now let's go to one of our policies and decide how we're going to do that. Okay, the federal funds rate is the most powerful tool. And you'll begin to see this as we explain this in greater detail. It's the tool that is not only the most powerful, but also the one the Fed prefers, because it is the least intrusive on the economy, okay? What I mean by that is the Fed would like to stay out of the economy. The Fed would like to allow markets to operate close to freely. When the Fed buys open market, when they buy bonds, do open market purchases, that's very aggressive, right? When the Fed goes out and buys government bonds, they're really affecting the market. So the Fed doesn't really want to have to do that, okay? When the Fed adjusts the required reserve rate, that's a policy that they don't want to do a lot, and it really affects the banks very dramatically, right? If you raise the required reserve rate, banks are going to be scrambling to find money. It's very intrusive, okay? It turns out the federal funds rate is their one chance to influence the economy in a way where they're not directly in it. They're not forcing the banks to do anything. They're simply manipulating incentives a bit. So they really, really like this policy. So let me show you how this works, okay? Let's think about a specific example. This is always the one that takes the most time to discuss because there's a lot of moving parts. All right, so with adjusting the federal funds rate, here's the situation we might be in. We need the money supply to go up, okay? So we need the money supply to go up. That means we need the federal funds rate to do what? We need the federal funds rate to be lower. That's what the Federal Reserve is going to think about. So it's going to go out there and it's going to think about the banks that are out there. You know, and banks maybe in a situation like this. Okay? A bank might have $15 billion in deposits and $3 billion in reserves. Or actually, let me just go ahead and stick them right up against the wall here, right? There we go, $1.5 billion. So assuming the required reserve rate is 10%, this bank is in a situation where it has no excess reserves. It cannot make any more loans, right? It's basically stymied itself from making any sort of choices. So what the Fed could do here is use one of its policies, okay? Specifically, let's think about starting with the first one, making an open market purchase. So the Fed goes out there and it buys stuff, right? Probably government bonds. The Fed goes out there and buys stuff. And what that does is it creates more money to go into the banks. When the Fed buys stuff, regardless of who they buy it from, more money is out there. So more money ends up in banks, right? Money is going to be spread out all through the economy. And money tends to find its way into banks because that is how people operate in the United States, right? A lot of our money goes into banks. Right? A bit of a tangent here, but think about this. You know, you might be thinking, well, you know, with my money, I spend most of it. But even if you spend it, it goes to someone else who might put it in a bank. Even if they spend it, it goes to somebody else who might put it in a bank. If you buy stocks, somebody has the money. Money usually finds its way into banks, and that's very different from other places it might go. Because when it enters the banks, it has a chance to multiply, you see. So some of that money is going to go into banks, and it doesn't just stop there. The multiplier effect gets going. So let's just say that this bank sees $1 billion roll in, okay? So $1 billion is deposited into the bank, so they now have $16 billion. When $1 billion goes in, right away, it's just reserves, okay? So now they have excess reserves. They have plenty of money. Right away, that'll increase the money supply, okay? So if we think about this, we're going to see there's two effects. One, the open market purchases have their own effect. That alone makes the money supply go up, right? Because it's new money going into the banks. New money goes into the economy. It goes into the banks. Banks maybe decide to loan this out or what have you. but regardless, you end up with more money, okay? Turns out this isn't the effect the Fed really cares that much about, right? It's what the federal funds rate does. So here is the second effect that you have. Since banks have plenty of money, they have plenty of excess reserves, think about how they're going to operate. If everybody in this class right now had plenty of money, do you think you'd be more or less likely to borrow? If you all have lots of money, you don't need to borrow, right? So since the banks have plenty of money, they don't need to borrow. And if they don't need to borrow, that's going to affect interest rates in the federal funds market. If banks don't need to borrow, interest rates are going down. Think about it this way. Let's imagine that I'm a bank and I've got a bunch of money. All right, this is going to be my money, okay? I'm a bank and I've got lots of money. Normally when I say, hey, does anybody want to borrow from me? I get plenty of people, okay? But in this circumstance, after the Fed has done the open market purchases, banks don't need to borrow anymore. So if I want to get a bank to borrow my money, I'm going to have to offer rock bottom interest rates to them. And the rates I'm talking about is the federal funds rate, right? That's what the banks charge each other. So after all this extra money is put into the economy, banks are going to have to drop the rates they charge each other to ever find someone to borrow. So the federal funds rate goes down. Okay? We're going to be thinking about this graphically soon, and I think that will help instill this idea when you see it on a graph. So when open market purchases occur, right, that alone makes the money supply go up. But the second effect is what the Fed really cares about. When the federal funds rate goes down, now banks can be more aggressive. Okay? Now that the federal funds rate is lower, banks can be more aggressive. That will cause more loans, and that also will make the money supply go up. So here's the thing. Anytime the Fed uses one of its first three policies, open market operations, changing the required reserve rate, changing the discount rate, anytime it does one of those three policies, it will necessarily also affect the federal funds rate, which will create an additional round of changes in the economy, okay? Anytime the Fed adjusts the money supply up using any of its methods, the federal funds rate will also lead to an increase in money supply, okay? This is clear evidence of that through the federal funds rate. Let's think about this now through the discount rate. Let's jump right ahead to number 3. Okay, so the Fed might look into its economy and realize that it needs the money supply to go up. All right? Just like we said before, it's going to want to do that by adjusting the federal funds rate. Okay? But to change the federal funds rate, it first has to do one of its other policies. So here's what it might do. It might drop the discount rate below the federal funds rate. Okay? This is likewise, just like we saw with the prior example, this is going to have two effects that both increase the money supply. All right? When that discount rate is dropped to 4% perhaps, what that will do now first is it will cause the banks to borrow new money from the Fed. Which drives the money supply up. Right? Hopefully you follow this. If you don't follow this, go back and rewatch this section of the lecture. When a bank needs to borrow, it's going to choose the lower rate. In this circumstance here, banks will borrow from the Fed because the rate is lower. that in and of itself will increase the money supply. All right, but that's not the only effect. Think about what happens next, okay? First of all, there's more money in society. So banks are less likely to need to borrow, first of all. But secondly, think about the interplay between these two rates. If you're one of those banks that has a bunch of money, okay, here's my money again. If you're a bank that has money, you would like to loan it out, all right? And chances are, if you've got a bunch of money laying around, it's because you didn't find any good borrowers from consumers. So you're hoping to lend your money to banks. Now, what rate are you going to charge? If you continue to charge other banks 5%, right? If you leave this rate alone, nobody's going to borrow from you because they can just go to the Fed and borrow. So what are you going to do with your rate? You're going to undercut the Fed, all right? In order to get to some bank to borrow my money, my bank is going to drop its rate to 3.9%. That also increases the money supply. Because now that the federal funds rate is lower, banks get more aggressive, make more loans, which increases the money supply. Okay? So banks get more aggressive. Making more loans, which causes the money supply to go up. Okay? So again, it's a two-step approach. This is the one the Fed really cares the most about, but they can't do it until they do some other step first. That's how the federal funds rate works. Fifth and final policy, all right, and this one I'm intentionally putting it separate of the first four, right? We went through the first four, and 1, 2, and 3 all kind of led to the fourth one there. This fifth one is different, okay? It's different because it's a new policy, and it might have different effects depending on what exactly is happening into the economy, okay? So the fifth thing that the Fed can do is adjust interest adjust the interest rate that the banks receive when they hold reserves at the Fed. It's a mouthful. All right? They can adjust the interest rate that banks receive when they hold reserves at the Fed. Okay, first of all, we got to explain what we're talking about here, and then we'll think about how this would affect the actual money system in the U.S. So here's the deal, all right? This is a relatively new thing. I don't remember specifically when it came about. I want to say it was like 2009. It was part of the Great Recession back in, that 2008, 2009 period. But the Fed created a new policy, which is when banks hold money at the Fed, they are paid interest. Okay? When they hold money at the Fed, they are paid interest. And I don't recall, I'll try to do some research, but I don't recall what the initial reasoning behind this policy was. But I know that partially the incentive here is banks do not have to be a part of the Federal Reserve System. Let me say that again. Banks don't have to be part of the Federal Reserve System. They can go out there and be in their own system. They'll lose some of the perks. They won't be able to borrow from the bank and from the Fed, for example. But it would allow them perhaps some more freedom if they're not part of the Federal Reserve System. So this is, first of all, going to create a huge incentive for banks to basically be a part of the Federal Reserve System because they will have the option to hold money at the Fed and get a return on that, okay? This is applied both to required reserves and excess reserves, although they have tweaked these policies over time. So what that means is if a bank has $100 million in required reserves, they'll probably get interest on that. And if they hold excess reserves, they'll probably get interest on that too. So how does this affect things? Well, there's actually two arguments. So first of all, we'll start with a first argument. I got to start someplace, so we'll start with one of these two arguments. The argument might be that this will increase the money supply. All right? The higher the interest rate is on these reserves, the more money there would be. Okay? The logic is this. When the Fed increases the interest rate on reserves, all right, and this doesn't really have a name like the other interest rates we talked about. It's just called the interest rate on reserves. So when the Fed increases interest rates on reserves, banks will receive interest payments that are new money. Okay? Pretty straightforward argument, right? If the interest rate on reserves is 2% and a bank holds $100 million in the Federal Reserve, that means they'll receive $2 million in interest during the year. And that $2 million will come out of thin air. It'll be brand new money to the economy. So this will increase the money supply. That's the first argument. I think that's the clear argument that one can make. However, there's a completely opposite argument that a person can make as well. So you could argue that it will increase the money supply. You can also argue that it will decrease the money supply. If this was a traditional class setting, I would let you guys think about it, and I think you would probably be able to come to this potential conclusion. So this argument has a completely different result. We could argue that this will decrease the money supply. Now here is the argument, okay? When banks know that they can earn interest on reserves, they may intentionally choose to hold extra money at the Fed. In other words, banks may decide to take some of their money that they would have lent to the housing market, right? They would have lent to the auto industry, or they would have lent to new business. Instead of lending that money out into the economy, they just hold it over at the Fed, okay? Now, why does that decrease the money supply? Well, when a bank loans out $1 million into the economy, someone else gets to use and spend that money. And then that money can go back into a bank and get loaned out again, and then back, and then again, and again, and again, and again. It can use the money multiplier effect. Whereas, if a bank holds its money at the Fed, it goes into the Fed, and it just sits there, okay? So if they hold extra money at the Fed, this will reduce lending and therefore reduce the money supply. I did this one separate, this fifth policy here, I did it separate because we don't really know how this policy works yet. It probably would work differently at different times. For example, if the lending market is really good, right? If banks are able to loan money out into the regular economy very easily and make big profits, well, then probably it would increase the money supply because they're just going to hold their baseline required reserves, right? Even though it gives them interest to hold money at the Fed, they'd still rather loan it out into the economy. At other times, maybe when the lending market is not so favorable, they may choose to hold a lot of extra money at the Fed, which would reduce the money supply. So we don't have a clear-cut answer on how this will affect the money supply. And likewise, we don't really know how this will affect the federal funds rate. Okay? If it tends to increase the money supply, it will tend to drive the federal funds rate down. But if it tends to decrease the money supply, like we explained here, it will tend to drive the federal funds rate up. So we don't really know how this will affect the money supply, but we know it can. So this is a policy that matters, even though it's not a clear-cut tool right now for the Fed.